everyone. Thank you all for joining in today and wish you all a very, very happy new year. As we start this year, we at DSP want to iterate our intent to partner with you all the way. Our constant endeavor is to help you have long-standing and enriching relationship with your clients. 1.5 years back at DSP, we attempted to do this in our own way through our publication Netra. Netra means eyes, and the purpose of eye, as you all know, is vision. Through this publication, which we release like clockwork by the 5th of every month, we attempt to give you a smart way to keep track of all the latest economic trends and insights in a visually appealing manner. We are very happy with the response that you and the industry has given us and very encouraged. So what better way to start the year with all of you than our first Netra for 2023 and with the architect of Netra himself, Sahil Kapoor. Sahil Kapoor, who I call a human library, is today one of the most popular macro strategists in India. He has a career spanning 15 years and started as a discretionary trader with the Edelweiss Markets Desk and moved on to wealth management. He joined DSP in May 2021, and is responsible for most of the recent communication that you see from our end, which has been garnering a lot of support and encouragement from all of you, such as Satya, Navigator, etc. I'm sure all of you will enjoy this session the same way that I do always. So thank you for joining again, and over to you, Sahil.
Thank you, Sunanda. Thank you very much for that intro and kind words. And welcome everyone and Happy New Year to you. This is the first 2023 Netra that we're going to discuss. And I hope I can give you more insights on all the key ideas that we put forth in this report. And in the last few reports, we've been highlighting and speaking about a number of ideas. And I will try to rope in and probably put them together and show you how these flow and what new data is telling us in light of the old data that we spoke. So I will try to do that as well. So let me start off and share a presentation for Netra. So this is the latest version for January 2023. As Sunanda said, every 5th of the month, this comes out and it is released online. And there are various ways to access it. There is a link which I will share in the chat box later, where you can access all the previous versions and editions of Netra. And in this Netra, we talk about 3-4 very important things. We start off with an actionable. And I generally refrain from putting actionable ideas such as what you should do directly in Netra. I give out ways and ideas on what is cheap and what is likely to do well. But this looks like to be a more actionable idea. And of course, it does not have a recommendation or a pitch to you, but a very important idea from the bullion market, from gold. And then we'll discuss about mid caps and emerging markets, and then we'll discuss a few aspects about Indian markets. So let's dive into the first topic, which is on gold. And so for last 1.5, 2 years, we've seen that gold has not been able to do well, gold prices. And, post-COVID, we had a very sharp rally from about $1,250 to about $2,000 or so. Gold moved, it showed a very large move, and then it went into sort of a hibernation. It hasn't moved in a 10 to 15% range and hasn't given any significant return in dollar terms. In rupee terms, the rupee weakness reflected in gold, and it gave a good 10% plus return in 2022. But in the background, what has changed is that the companies which mine gold, which is called gold mining companies or gold mining stocks or gold mining equities, these companies have improved on their financials quite a lot. So if you look at this slide on your screen, all these companies, I have taken 6 large global gold mining companies, because in India, there are no gold mining companies. So you will have to look at international markets to take a clue on what is happening in this sector. I've taken the 6 large companies which control the lion's share of gold mining. When you look at these companies and when you look at their balance sheet, so if you see the trailing 12-month net debt, which is the indebtedness or the balance sheet of these companies, they have reduced their debt levels tremendously. So from the peak of 2014, if you see recently, some of these companies have become debt free. They are now sitting on cash, or they have very low debt levels. So that means they have paid off their debt over the last 2 years, utilize the post-COVID period to improve their balance sheet. Just a few years ago, many of these companies were staring at going bankrupt because of very high debt levels and unsustainable prices. Secondly, you can see that their cash flow position has improved tremendously. You can see they are delivering very strong free cash flow, which is a very rare occurrence for commodity companies where the underlying price of the asset has not gone up. For example, steel companies will not be able to throw huge free cash flow if steel prices don't move up. Similarly, for a cement company, similarly for a metal company. But in this case, you can see over the last 1.5 years, they have reined in their cost and they are delivering good, steady free cash flow. I will talk about this small dip, which is very important, and I'll talk about at the end. And the valuations are also very attractive. You can see that from a historical standpoint, they are close to their trough, not exactly at the lowest level, but they are very attractive. So, for example, if you were to do a pecking order globally on what are the cheapest opportunities in the world right now, at the top, you will see gold mining and maybe part of the healthcare market in different countries. These are the one of the cheapest sectors globally which are available today. And gold mining, of course, features at the top. And the return ratios, ROEs, are also very healthy right now, touching about 15%. If you see that in all these numbers, there is a slight dip here, there is a slight dip here. And why this dip happened is because of elevated commodity prices, specifically energy prices. So their input cost went up. In last 3 to 4 quarters, these companies have seen a deterioration in profitability. And that is one of the primary reasons why these stocks did not do well, right? And the other major reason why these stocks did not perform as well is because gold prices did not go up. And recently what we've seen is that, so in the last few instances and in some of my public discourses, I have spoken about that if you were to create a small copy and write the reasons for gold to do well, you will be able to tick mark all the boxes, except only one thing, which is the next slide, which is a very strong dollar. So last 1.5 to 2 years, dollar has appreciated significantly. The dollar index went up almost 22 to 25%. And that caused gold prices to go down. So you can see from post-COVID highs, gold prices haven't really done anything. They have been in a correction mode and largely reflecting the strength in the dollar. Recently, what we saw is that dollar has weakened. So if you recollect the first online interaction that we did on Netra, we saw almost 2 to 3 instances where through slides we showed why dollar should weaken. And that has played out over the last few months. And we believe that this weakness in dollar will translate to stronger strength in gold prices. And historically, when gold prices move higher, that means they enter a secular bull market. Gold mining stocks deliver even higher returns. So for example, if gold prices move up by $100, gold mining companies will move up by $150 or $200. So they offer 1.5 times to 2 times the beta of gold price. So if you follow my line of thought, what is the line of thought? Gold mining companies are in pink of health. Their balance sheets are very strong. They are throwing good free cash flow. Their valuations are attractive because markets have ignored this segment completely. The biggest hurdle for them to perform is the gold price itself. So if gold prices go up, their profitability will rise significantly because let me give you an estimate. Every $100 additional increase in gold price will translate directly to higher profitability for gold mining companies. So when you look at these companies and their earnings calls, they are saying that they are penciling in gold prices at $1,250 to $1,500. Any additional price above $1,850, that will directly flow to the bottom line and improve their profitability. So if gold prices were to break to a lifetime high, which is above 2,100, it's very clear that gold mining stocks will do very, very well. So gold mining equities globally is a very strong theme. You should explore how to play this theme. There are not a lot of opportunities, just one vehicle in India to play this. So this is one of the most important ideas that we wanted to put forth in this version of Netra. The next is take on what will happen in the various capitalizations. So if you see the chart on your screen, it has a black line, and this line represents the ratio of mid-cap stocks to large-cap stocks. That means mid-cap world index divided by world large-cap index. So when the black line is going up, this means that mid-caps are outperforming large-caps, or they're rising at a faster pace. And when this line doesn't do anything, like it has not done anything in the last 14 years, that means mid-cap stocks are underperforming large caps, or they are not performing as well as they used to, right? So what we've seen is that there are cycles, and there are a few reasons why mid-cap should do well. One of the reasons is that over the last 10 years, 15 years, huge amount of monetary stimulus, excessive use of technology, various reforms globally and in India have caused large corporations to have higher market share and also squeeze out smaller companies. So smaller companies have not been able to compete with larger companies over a period of time, and therefore their profitability shrunk, and they did not do well. And also the starting valuations for mid caps after the GFC and after 2011 peak, they were not very, very conducive for them to do well. Today, what we see is that globally, mid and small cap companies are attractively priced when you look versus the large cap. So if you look at, let's say, the world mid cap index versus the large cap index, the mid cap index has a lower starting valuation in terms of price to earnings. Same is the case in US, same is the case in Eurozone, in Japan, also in India. So starting valuations are good. Secondly, the cycle has run for about 14 years. Thirdly, this polarization that we saw in the market where large corporations became extremely large, for example, a FANG, right? For example, some Ritik stocks in India, that seems to be going away. It's going away when you look at the profitability profile of smaller companies. It's slowly returning back. And secondly, if you expect widespread steady growth, that means in Indian economy to improve from the shocks of COVID, then you will see that MSME universe will outperform. And last year, if you see Nifty SME index, that is one of the best performing index. So we feel that over the next 2 to 3 years, it's quite possible that X of large cap, the smaller capitalization, mid and small cap stocks, what we call SMID, small and mid cap stocks, these stocks will probably do better. And this should not be just an India phenomenon, it's a global phenomena. And I think we are at the right time, at the cusp of participating in this phenomena. This may not play out in the next 3 months. Maybe mid-cap would underperform or not do well. But from a 3-year perspective, I think this is the right time to have this capitalization in our portfolios. The next is again a very, very similar point on emerging markets. So emerging markets, if you recall in the last 2 instances also, I showed you a few data points saying that why emerging markets are A, much more cheaper than developed markets, B, are cyclically at the bottom point, and D, where we are seeing that flows are reversing in emerging markets. And now we have more evidence. We are seeing that emerging markets have started to do well. For example, Hang Seng index is up 50% over the last 2 months. MSCI China index is up 50% over the last 2 months. Many emerging markets have made a comeback. India has done nothing over the last, I think, about 10 weeks, we are flat. And if you remember, we had spoken about this, that there will be a catch-up for other emerging markets which are trading dirt cheap, and maybe some consolidation in Indian large caps. I think that is what has happened. Going forward, I think emerging market pack is probably better placed, both in terms of growth, in valuation, and probably also policy support. So if you look at the developed piece, most central banks are hawkish. Governments don't want to enact any fiscal stimulus anytime soon. At best, when monetary policy turns in the developed world, they will turn neutral. If you contrast this with emerging markets, some of the emerging markets, for example, China, they are trying to reconstruct the recovery. When you look at India, Indian policy is much more benign versus what we have seen in the previous tightening cycles. So it's very clear that emerging markets most likely will continue to do well, of course, with its fair share of volatility. But next 2 to 3 years, if you were to pick between developed and emerging market, you should probably bet on emerging markets a lot more. And India, being a very prominent and large part, will benefit more. So, for example, In 2020, prior to COVID, India's weight in emerging market was 8.5 to 9%. Today, it is 14.5%. So if FI flows come back to emerging markets, India will get a higher share of flows versus what it got in previous upticks, right? So this is again going to be a more beneficial scenario, not just for equity flows, but balance of payment for India and for external situation also. So the key takeaway conclusion from this slide is A, EM likely to do well. B, that rub-off will help India also, with India being strong on weightage plus also strong on earnings growth. India will also benefit from this trend. The next is global growth, which is very important. And if you see two lines, black and blue, the blue line is US manufacturing. And you can see that the manufacturing in US has turned negative. It is in contraction zone. And very recently, just 2 days ago, we also had the services sector report for US, right, which is called services PMI. That also entered contraction zone very recently. But that point being different, the key theme is that manufacturing in most part of the world, whether it is US, Eurozone, for that matter, China also right now, most of the developed world, it is witnessing contraction in manufacturing sector. And usually what we've seen is that metal prices find it very difficult for them to go higher when manufacturing is actually contracting, right? So in generally in these phases, they remain soft. And right now what we are seeing is a divergence. Metal prices are witnessing a uptick. Largely, there are many forces to it, not one single reason. Markets don't move because of a single reason. For example, some amount of restocking with China reopen has happened. But I suspect that this remains a little dicey, that this rebound in metal prices could possibly be a whipsaw, and you could again go back and see metal prices cooling off ahead. So global growth is slowing down. It is becoming challenging. And this will have a rub-off on many globally linked sectors. For example, metal prices, for example, oil and gas prices, for example, IT. So many globally linked sectors will continue to see this drag from global slowdown. And this will probably take at least 2 quarters to go away. That is how I think it will play out. So the conclusion is that many of these globally sensitive, growth sensitive sectors will remain in consolidation, or possibly will remain on the back burner for the time being, at least for the next 2 quarters. The next chart is very important, and it is about inflation. So if you see, there are 2 lines on this chart, and there is a background sort of a music of CPI. So the 2 lines, which is one is the orange line, which is just crude prices, which is Brent crude prices, and the blue line is wholesale inflation minus retail inflation, WPI minus CPI. All of this is India inflation. And in the background gray, this is India inflation, which is CPI, which is reported every month, right? So if you look closely, this blue line moves very closely with the orange line, which is Brent crude prices. So what does this mean? That if wholesale inflation is falling at a faster rate than retail inflation, usually it happens because commodity prices are going down, right, at a faster clip. And because of that reason, wholesale inflation goes down faster. So if you remember, for 22 months, India's wholesale inflation was in double digit. For a number of months, it was close to 14%, 12 to 14% range. Now it has declined to sub 6% levels. We believe that by the time we reach April, May, June quarter, which is Q1 of FY24, WPI will become 0% in India. That means it is going to go towards contraction. This will have a smoothing effect on CPI inflation also. That means our retail inflation will also fall. So by the second half of calendar year 23, our calculations show that our inflation, that is CPI inflation, retail inflation, will actually go down below 4.5% or so, right? That's possible. So what is the key takeaway? First, that wholesale prices are coming down, so input prices in the economy are falling. Second key takeaway, once inflation slows down, you will see that RBI will have more room to exercise its monetary policy. That means it will no longer look to raise interest rates aggressively. In the Feb meeting, it may raise or may not raise. I'm not very sure, but there are chances that it might abstain. But going ahead, if we don't have any new surprises, for example, a new war or some other new dynamic which comes up, on a steady state basis, it does appear that RBI will take a pause and probably look to smoothen out monetary policy going ahead. This is the implication of this chart. Again, I have used the same series, WPI minus CPI, and I'll just remind you that what I said initially, that when wholesale prices are falling at a faster pace and retail prices are not, so just think about it. Wholesale inflation is falling. That means input prices for companies, for example, their energy cost or raw material cost, will fall at a faster pace than their selling price. That is the price of the output goods that they produce, because retail inflation is falling at a slower pace. This will cause corporate margins to bottom out. And I think the result season, which began today, we will see corporate margins will bottom out in this quarter. And this is one of the aspects that markets have probably not discounted or not fully appreciated, that in FY24, you will get some support from margin expansion, particularly in sectors which are more domestically linked, right? So, for example, if you were to divide Indian sectors into commodities and export-oriented sector, those sectors like metals, part of chemicals, part of pharma, part of IT, these sectors will see margin compression, right? The other part which uses commodities like local consumer discretionary goods like autos, right? Local building material companies, OMCs, which are retailers in nature, these companies will see margin expansion. And because of that reason, one part of the market will see growth, earnings growth because of margin expansion. The other part will see margin contraction. And as a whole, you will see that Nifty earnings will struggle to be between 12 to 15%, right? That will be the range. And this is the complexion of the change. And this chart, exactly the same chart we had shown in December 2021. And there I have just extended that and updated the data. You can go and see. And we had highlighted that margins have peaked. We made a case that markets will enter a mode of consolidation in 2022 because margin compression will hit profitability. And it has played out that way. And we believe that this series is now bottoming out. And over the next few quarters, you will see margin expansion play out. And December quarter will probably be the bottom, maybe March. If we are right, then probably December should be the bottom. And you will see margin expansion play out and support earnings, right? So, for example, I'll just give you one or two numbers. The current quarter that we are seeing, the results which have started, in this quarter, BFSI will see, lenders particularly will see a profitability jump of 30% YOY. Such a large number. We haven't seen that kind of number in years, right? And at the same time, metals as a pack, if you just look at the numbers, they're going to show earnings compression of 50% YOY. There is a degrowth which is there. So this kind of divergence is happening in the market. And that's why when you look at the headline level, you will see that profitability looks little shaky. But when you look under the bonnet, many sectors are doing well. And this will support the market, the margin expansion in these sectors. So the key conclusion, one, that WP and CPI is telling you that corporate profitability going ahead will be supported by margins. Demand is a different scenario. All the strategies in the world have their own call on whether growth is slowing or fast quickening. We believe that India data is still showing that growth is steady. As I've said on many earlier instances, we may not be hitting sixes out of the park like Surya Kumar Yadav, but we are still doing well. Indian growth is steady and much more solid than many parts of the world. The next is on flows. And this is an instance where we had put three specific charts. In May 22, we highlighted that the extent of FI outflow clearly tell you that Indian markets are somewhere close to the bottom. And at that point, I think we were close to 16,500 or 16,000 and odd, right? On the Nifty. And since then, we saw in H2, FI flows reversed. Last month, in December 22, we put out a chart saying that the global indicator for risk, which is a memo item that Fed publishes, what is called the global euro dollar market, that is beginning to tell you that FI outflow from risk assets like emerging markets will stem, they will stop. And probably they will start to put money in risk asset like emerging markets. And we are seeing the first sign happening in emerging markets where huge inflows have happened in China and other emerging markets. India most likely will see a very large share of FI flows in 2023. So if you look at this chart on your screen, there have been few instances where FIs have pulled out money on a full year basis from India. For example, in 2008, they sold $13 billion worth of Indian stocks, and which caused a 52% decline in Nifty. If you remember, 2008 was a brutal year. Again, they sold about $5 billion in equity in 2008, the year the IL&FS crisis took place. And the same year, they also pulled out money from debt, right? And there are only two instances, this and this instance, where FIs have pulled out money both from Indian debt and equity market. They have not done that in the past other than these two instances. So calendar year 22 was unique, with highest FI outflow from equity markets and both equity and debt markets seeing outflow. And markets were mostly stable. They did not do much, go up or down, although mid and small caps declined year on year. What does history say? So the other two parts, which I told you earlier from May and December, Netra, and this chart clearly tells you that in 2023, FIs are most likely to be net buyers of Indian equity, both because of this dumb data which is on your screen, and also because of international position in terms of euro dollar market and the risk sentiment. One of the largest risk indicator that we've been tracking is, of course, the dollar index, which has reversed from extremely high readings. It might be volatile, it might again have an uptick, but I think on the whole, in the next 12 months, the probability that we'll see FIs inflow is very, very high compared to the probability that we'll again see a 2022 kind of a year. So this will have more repercussions for India. Possibly better flows means our balance for payment will improve. The pressure from rupee will go away. Our FX reserve will get boosted. And all of this will have a very important bearing on our monetary policy. Okay, I can go in detail, but a very important channel through which flows help any country is not just equity prices. It is also about having a better hold on domestic monetary policy. So monetary policy, for example, in India works very well when there are three conditions. One, RBI is easing. Two, the Fed is easing. And three, there are flows which are coming to India. This is the what you call Goldilocks scenario for monetary policy. In 2023, I think maybe at the fag end or in the second half, this scenario is possible. And when will that happen? I don't know. I'm just guesstimating second half. Maybe it has already started. I don't know. But the probability that this year we'll see that kind of a pattern play out is very, very high. And therefore, this is something to watch out for. The next is about Indian banking and financial services. As you've seen that we've highlighted BFSI for a number of months. I think we've been talking about this for the whole of 22, and financials were one of the best performing sectors. I don't think we have ended. They are into a 2-3 year cycle. There is also something which is very, very unique and important, which we have noticed. So if you do a market cap sorting of all the world banks, so if you put all the top banks of the world by market capitalization, this data is X of China. I have not taken Chinese banks, which are very large in nature, but I have not taken them here because of obvious reasons. But X of China, there are 3 Indian banks, which makes it to top 20 banks in the world. Although when you do a full market capitalization of all companies of the world, so if you do a pecking order and you take all the companies of the world, first Indian company starts at number 44. Okay, so for example, number 1 will be Apple or Saudi Aramco. Whenever when you are plotting it, in that order, if you do, you will see that first Indian company to make the cut will be Reliance at about 44. But when you do it same for the banks, first bank is HDFC, which enters at about number 14. what does this chart tell you? The size of the bubble, if you see, is the price to book. Okay, so for price to book for this Indonesian bank and all the three Indian banks is quite large. That means we are paying a premium price for these banks. And why are we paying a premium? If you see, they enjoy the highest net interest margin in the world, and they also enjoy one of the highest return on equity globally. And that is one of the reasons why Indian banks are able to show you strong compounding at scale. And market rewards companies which compound your wealth at a large scale. Their scale is large, and that is the precise reason why Indian banking commands such a premium globally. And most likely they are in for a good cycle for the next 2 to 3 years because of three reasons which I have repeated many times: that balance sheets are clean, credit growth is strong, and the quality of growth is also strong with very low NPAs, right? So banking, we continue to remain bullish, and over the next 2 to 3 years, this is one of the area which will probably do well, right? The last is on fiscal deficit, which I think the worries have been overblown. We believe that as growth catches up, you will see that fiscal deficit will slowly begin to come down, although still we are at an elevated level. Why are we so elevated on fiscal deficit? So I've tried to put it here. So if you look at FY20 prior to COVID, our real GDP was 145 trillion or 145 lakh crore rupees. Okay. And when COVID happened, our GDP became 136. So we degrew from FY20 to 21. Our GDP actually fell. So I have also plotted these bars here, which are shaded. What is this? This is the real GDP, assuming that COVID did not occur. So if COVID had not happened, we would have closed FY23 at 173 trillion rupees of Indian GDP, which is 173 lakh crores. But where are we closing? We are closing at about 158 lakh crores. 9% lower than what we should have been if there was no COVID. Okay. This means that Indian GDP has not fully recovered, still not fully recovered. And that is one of the reasons why government continues to spend a lot more money. And that's why we are seeing higher fiscal deficit. But as growth recovers over the next 2 years, we believe that fiscal deficit will slide down and it will become a smaller worry. A lot of people worry about these large numbers, but the markets don't work on absolute numbers. They work on rate of change. They look at how these numbers are becoming smaller over time, and that is how they look at these numbers. Our assumption is that in the upcoming budget, the fiscal deficit number may not be significantly troublesome. It could be between 5.6 to 6% given how government wants to do it, how government wants to look at its financial. But on the whole, this number is improving, and these worries will taper down over the next 2 to 3 years. So this was the last slide, and this last qualitative slide is about rule-based funds. We believe that all funds which are rule-based, act like ponderosa pine, which is a very special tree which has got fire protection properties, which I've enumerated here. And similarly, rule-based funds are like that. They help you stay in the game for a very long time and help you survive. And I think this is a message which will probably, you will have to go back and see what rule-based funds are and what they can do for you. So this is it. I have come to an end to my monologue. Thanks.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.